Alrighty. Now, before we dive into the wonderful and juicy topic of liquidity, I was thinking about, what's going to be the best way to teach this. And I quickly realized that, especially if you're going through the course for the first time, before we kind of get lost in the source and we get quite technical with things and we start to dive into even more concepts and more variables to be thinking about with your trading, I think it's first good to take a step back and think about what is the overall philosophy here behind what we're trying to do. What's the overall strategy? Like what is our framework for how we're looking to enter trade. So what we're gonna do now is kind of go through a very, very high level, I mean, it's not super high level, but reasonably high level trade plan. Just thinking about the major concepts you've learned so far, which is market structure and supply and demand, right? They're the two main modules that we've looked at for technical analysis. Let's think about how we could just trade those together into a trade plan. And then obviously we're going to spend this module you're now dipping your toe into to overlay and bake in the liquidity concepts within that. Okay, so kind of if you think about it, three main concepts that you use within your trading: market structure, supply and demand, liquidity. Before we add in liquidity, let's just think about how we can trade supply and demand and market structure together. And I think that will really help you to not get too lost as we go through things, and it will hopefully make a lot more sense. Now, with that said, there will be an entire trade plan module shortly after the technical analysis module where we'll go into this in a lot more depth again. But again, let's just go through it now with supply and demand and market structure. So as you can probably see with this diagram here, this is probably, as kind of as simple as I can make it. If you think about, let's say, trading with just two time frames, right? And you've got your higher time frame, whatever one that is that you pick, and your lower time frame. And the general idea is, if you're just thinking about one time frame, right, and we see that price is bearish, we know that supply is in control, the lows are weak, the highs are strong, right, because they're breaking structure, so we expect that to be respected. We can look for shorts in supply, and we can target these weak lows, right? We expect demand to fail, so on and so forth, until eventually what happens, structure shifts, where we get that bullish shift in structure. What do we also know then? When you get a bullish shift in structure, when we look at supply and demand, we know that that means supply has failed, and it's likely demand is starting to take control if we then see demand be respected and demand hold, okay? So again, thinking about one time frame, we can look for shorts from supply, targeting those weak lows, and then eventually supply will fail to do its job, demand will step in, structure will shift, order flow will shift, we then look for demand to take control. We need to see it be respected, okay? So at that point, previous unmitigated supply zones, what do they become? They just become reaction points for pullbacks. We then expect demand to hold, and that's where we can then look for longs to target the weak highs, right? The highs now become weak because they failed to break structure. And again, rinse and repeat. We look for price to come into demand. This is now a strong low, and we can look for longs from demand, right? That's just one time frame. So basically what we want to be doing is following whatever higher time frame it is that we individually choose, but we want to use a lower time frame to help with confirmation of these zones holding, but also to give us increased refinement as well, right? To increase our risk to reward, because rather than, let's say, entering on this POI directly, which of course we could do, and imagine this was a real trade example and you've got 138 pip stop. Instead, when price comes into this area, as soon as we hit our higher time frame POI, we drop down to our lower time frame and we just look for the same thing, right? We look for that lower time frame order flow to shift, lower time frame shifts bullish, lower time frame demand takes control, right? And then you can get in with, let's say a 65 pip stop, which would be, more than half, less than half, I should say, of what the risk to reward would be here. So that means, your stop loss size, that means you essentially double your risk to reward, right? So you get extra confirmation that this POI is holding by waiting for the lower time frames to shift in your favor. It's basically just a timing mechanism to show you that, price isn't just going to blast straight through, that potentially this is holding. And then we also get the increased risk to reward, okay? That is the bare bones philosophy of what we're doing. Following everything on the higher time frames, waiting for price to enter our higher time frame POI. We understand what the higher time frame narrative is, the higher time frame story, because we've seen that it shifted bullish, and the expectation for the next higher time frame move is that. But once price gets here, rather than just entering long directly, we just wait for the exact same thing to happen on the lower time frames, right? Remember, markets are fractal, so price comes in the lower time frames, and this pattern is the exact same as this pattern, right? It's just price being bearish, then it shifts bullish, and we get enter another demand. Same thing here, right? But this lower time frame execution is what we're going to be using in every one of these higher time frame POIs, right? Not every single one, but whenever you want to trade a higher time frame POI, if you deem it to be high probability, you've built the higher time frame story, i.e. if we've been heavily bearish, we pull back up to this extreme supply at the strong high. When price gets here, what do? You jump down and you look for your lower time frame execution model, okay? But obviously it would be a bearish one, not a bullish one. Okay, so that's the general idea. There are various entry models, and that's what you're going to learn towards the end of the liquidity module. But first, I kind of just wanted to give you the guys the general overarching philosophy of it, and it's basically higher time frame ideas, higher time frame POIs, lower time frame execution. We're not sitting on the lower time frames just trading lower time frame order flow, right? This is what comes first, right? This is how you will get consistent, how you will make good money. This is just what you do once price gets to those areas. So that was when we're just looking sort of at, two basic time frames and just thinking about it in sort of its most simplistic form. Again, higher time frame ideas, lower time frame execution. Now we've got a bit more of a complicated diagram, okay? And again, when you first look at this, it can just be like, oh, what is all this? Loads of words, boxes, lines, circles everywhere. But hopefully you should be a little bit more familiar with the kind of general idea of this as we've gone through the course. Hopefully you've watched it in chronological order. So this gives a bit more of a realistic idea of kind of how the market moves and how we're gonna look for trade ideas. Okay, so we'll go through it slowly. Don't worry, you don't need to fully wrap your head around this at this stage, but you keep coming back to this. This will be the general core framework of what we're trying to do. So again, before we dive into this, what I want you to now think about, which will really help to get your head around this, is think about 3 time frames. So when I think about my trade plan philosophy, my strategy, what I'm doing, really it comes down to 3 time frames. It's having a higher time frame, a medium time frame, and a lower time frame, okay? So essentially, the higher time frame is the objective, it's what you're looking at. So if you think about this big thick black line here, right? Now, I'm just gonna keep saying the higher time frame because it can be any time frame you wanna use. But when we have a big bullish higher time frame trend, think about it that way. When I say about you want to know kind of what the objective is and when you want to know what the narrative is, it simply just means, are we currently in the pro trend run phase? Are we currently in that pro trend leg? Or are we currently in that higher time frame pullback phase, the counter trend pullback phase? Because all the higher time frame is in this example is an up movement, the down movement, right? The pro trend run, the one counter trend pullback phase, or again, the next pro trend run, okay? So that's the counter trend pullback phase, and that's the pro trend run phase, okay? And you just want to know, are you either in the pro trend run phase or are you in the counter trend pullback phase? That's it, okay? You don't need to overcomplicate your chosen higher time frame any more than that, okay? So when you then look at your medium time frame or your mid time frame, whatever you want to call it, unfortunately this acronym overlaps with multi-time frame analysis, but in this case, what I'm saying is your medium time frame. This is kind of what we call, or we use for your immediate bias. And these are the POIs that you're going to be looking to trade from, okay? So your medium time frame is kind of like your ideas time frame. This is the one you're kind of following, that session, that day. Those supply and demand zones on your medium time frame, they're the ones that you're looking to trade, right, from those areas. Your lower time frame is what you then use as your timing mechanism, but for your medium time frame, okay? So you have your overall higher time frame. You just want to know, are you currently in the pro trend run phase, or are you in the higher time frame counter trend pullback phase? All right. And the reason why that's important is because it tells you what to expect with your medium time frame. It can signal when you expect your medium time frame to change trend. So i.e. when we're here on the higher time frame and we're in that pro trend run, we know we've had that higher time frame boss. And what do we expect after a higher time frame boss? We expect a higher time frame swing pullback. So we know if we're sitting on our medium time frame, right, and we're following the bullish structure on our medium time frame, right, and it's bullish and we can look to buy these, we have to expect that any time when our higher time frame reaches a higher time frame supply, that our mid time frame is probably going to change trend to do what? To facilitate the higher time frame pullback, right? So that's why the higher time frame will signal when our medium time frame may change trend, okay? So again, what we're going to be doing with our medium time frame is we're going to be following that for our immediate bias and with our POIs, okay? And the way you want to think about the medium time frame is it's the soldier for the higher time frame, right? The medium time frame's job is to fulfill the higher time frame objective, okay? So at this point, when we're having the higher time frame pullback, if you're shorting and you're following the medium time frame because it's bearish, right? you have to understand that its objective at that point, it's switched bearish to do what? To facilitate the larger pullback. Likewise, when the medium time frame shifts bullish here, why? Because its objective is to now fulfill the pro trend run, right, of the higher time frame to target that week high. Okay. And then again, that whole time, all of these medium time frame POIs and prices coming into them, we can look to trade them, but with our lower time frame execution. Okay. So again, that might be a little bit confusing to get your head around. I totally get it, but this will become a lot clearer as you go over this and go over this and go over this. Okay. It can seem very, very complicated, but I promise you this will become second nature. We don't even need to really think about it. So what I've put over here, right, is kind of two ways you can think about this. Is one as more of a swing trader and as one as more of a day trader. Now, these aren't technically, definitely, if you're just a swing trader, you would do this, or if you're just a day trader, you do this, because you could use this plan and you could still enter and exit in the same day, intraday. So technically you are a day trader. Likewise, you could use this plan and entering on the M1, and you could hold your position for days or even weeks. If you get in the right area down here on the M1, you could still hold this for a long time, okay? So it's not kind of the true definition of day trading and swing trading. It's just an easier way of us classifying kind of what time frame you're entering on. And if you're entering on the M15, it's a bit more of a hands-off, slower approach. And typically if you're entering on the M1, it's a bit of a quicker approach, okay? So let's say you're a swing trader, and this is what we recommend you start off with, is you start off with M15 entries, okay? So you'll be using M15 entries, that's your lower time frame, but you'll be trading 4-hour ideas, okay? So your medium time frame will be the 4-hour chart, and then your daily is your higher time frame. And then if you're, let's say, more of the day trader, you just drop them all down a time frame. So your higher time frame will be the 4-hour chart. So you want to know if you're trading those 4-hour pro trend runs or the 4-hour pullbacks. Your medium time frames, the time frame you'll be trading the POIs, your ideas will be the M15, and then you'll be using, let's say, the M5 or the M1 for your execution. Now, these aren't, hard, strict rules. For some of you maybe trading M15 entries, you may find the 1 hour can be really handy, but this is kind of just that general 3 time frame philosophy of what you want to be following, okay? So let's kind of go through this piece by piece. So again, let's say, let's do it like as if you're more of a day trader, right? So your high time frame would be your 4-hour, right? We have a 4-hour break of structure, okay? Now, the moment we have that 4-hour break of structure, in the back of our minds, we can be thinking, okay, we might get that 4-hour swing pullback at some point, right? But it's not just gonna happen straight away. So if we jump down to our medium time frame, which is gonna be the M15, okay? That whole time, you might see bullish structure on M15. It might just be internal, it might be swing, depending on how big price action is, but you're gonna see that bullish order flow on the M15, okay? Now, what you can be doing this whole time is, I haven't drawn this very well, but as price is pulling back in, we could look for longs, right? There'll be M15 POIs here that we can look for longs, but we know at any point that larger swing pullback can happen on the 4-hour chart, so we have to be quick with our targets. But every time price comes into one of these POIs on the M15, what are we doing? We jump down and we quickly look on the M1 for an entry, okay? So that's what you can be doing. But like I said here, when the higher time frame is bullish, right, you can consider taking those long continuations from your medium time frame POIs, so your M15 POIs, following the M15 internal structure, okay? So this be on the M15, following that M15 internal structure, but being aware that at any moment, that M15 internal structure or swing structure could switch bearish, and we could have that deeper 4-hour pullback, okay? So you wanna have quick targets. Now, thinking back to your higher time frame, the 4-hour chart, once that reaches, say, another 4-hour zone, that higher time frame zone, that increases the probability, right, that we're going to get that higher time frame pullback. Now, this whole time, the simplest way I can say to you is you should only be trading once your medium time frame POI has been mitigated, then you look at your lower time frame. Okay, so if I can keep it even more simple for you, just be thinking mainly about your medium time frame, and until that medium time frame POI is hit, you cannot look for a trade entry. Only once your medium time frame POI has been mitigated, i.e. the M15, then you can look for lower time frame entry. So if price comes into your higher time frame POI and it hits your refined medium time frame POI within that, right? At this moment, technically now you could look for a lower time frame entry, right? Because it's within your M15 POI. So you could drop down to the M1. But you have to ask yourself is, you're trading heavily counter trend now. Everything's super bullish. So this is where it might be a bit too more advanced, right? And you might want to wait for what? Wait for your medium time frame to shift bearish. Because now what you're doing, now if you wait for the price to pull back in, now you're trading in line with your medium time frame, okay? So I appreciate this is a lot of things to think about as you go through the course and later into the trade plan module. This will make a lot more sense. And what we recommend is you pretty much focus on at least always trading in line with your internal trend on the medium time frame, okay? Because at this moment, right, like I was saying, you've technically hit your medium time frame POI, right? So this is where you're then allowed potentially to drop down to your lower time frame, i.e. the M1, and look for an entry, sorry. But you're trading, everything's bullish at this moment, maybe apart from like the M1. So do you really want to take that trade? And that's where we recommend, right, waiting for your medium time frame to shift, okay? So that's when you may see, right, your medium time frame fail. This might be like an M15 boss or an IBOS, depending on how structure is. Then you wait for price to come back into that supply. And then again, you've come into your medium time frame POI. You're trading from that strong medium time frame high. So what can you do? You can jump in and then look for your entry on the M1, let's say, right? Or what you may want to do is wait for an M15 shock. That gives you a fresh M15 POI again. And then in here, you can drop down to the M1 and look for your entry, right? Now price is coming down. You do not want to be buying from this week low, right? That was the strong internal high. That was the weak internal low. You waited for price to pull back into your M15 POI, and then you looked for your entries on the M1, right? Now you want to target the weak M15 low. And that's what we do. So then when price breaks that low, what do we have? We now have a new M15 internal range. So that's the new range you'll be marking on. So between those two orange lines, that's kind of when you're coming into the session, that's your immediate bias. You're like, right, the M15 is bearish, so I want to look for shorts from my M15 zones. That's what you're looking for. So you look for your M15 supply zones, okay? And you're going to look for entries. But you know that the higher time frame, the 4 hour, is bullish, and you know that the only reason why the M15 is bearish is to facilitate the 4 hour pullback. So you know you're going to be quick with your targets, right? You're not going to hold on for your shorts all the way down here. You're just looking for quick moves down to the week low or like down into discount demand, okay? So, if I can simplify it, again, because I appreciate this diagram can be a lot to take in, is each time you come to your chart and your session, you want to know whatever your medium time frame is, okay, if it's the 4 hour or the M15, and you want to mark out the current medium time frame range you're within, okay? So when we're between this strong high here and this strong low, your medium time frame is bearish. So your immediate bias should be shorts, okay? So what you want to do is you want to outline where are your medium time frame supply zones within that current medium time frame range, right? So again, I'm going to talk about it if it's the M15. You want to look for where are your M15 POIs, right? You want to look for shorts, wait for price to come into it, then it comes into it, and then straight away you may want to look for your M1 or M5 entry model, or maybe you want to wait for an M15 shock just to give a bit more confirmation that this is holding, right? Because it is counter to the higher time frame trend. Again, price comes into the fresh M15 zone that caused that shock. As soon as price comes in, what do? Jump down to your lower time frame and look for your entry model to then target the low, right? Then we get that M15 break of structure, right? It might be an IBOS, it might be a boss, depending on how things are set up. And now you know you're in this bearish range now, right? This becomes your strong high that broke the low. So this is your immediate bias. You want to focus on shorts from M15 zones, right? Your medium time frame. So you've got a zone here, you've got a zone here. We never know which one price will pull back to. So when price comes in, what do? Drop down to your lower time frame entry model, look for it, target the week low, okay? Take your profits, reset. Now what do we have? Well, this becomes our new strong M15 high that took out that low. This becomes our new M15 low. So this is the range we're within, okay? Not that one. So now what could you do? Well, your immediate bias is bearish for the M15. So wait for price to come into your M15 supply zones and drop down here. Well, maybe you want to do that, maybe you don't, because where are we within the higher time frame? Now we are in the discount, right? This is the EQ of the 4 hour leg. We've now pulled down into the discount, of the 4 hour chart. So what do we know from the higher time frame? We know at any moment that 4 hour high low could kick in. So shorting from here now is a lot lower probability, right? Because that 4 hour high low could form. So maybe you want to take shorts up here, maybe here, but now once we've pulled below the 4 hour discount, or maybe there's some 4 hour demands here, this is where you may want to hold off in shorts and just be patient. And now you want to start thinking about longs. So as we pull down into the 4 hour strong swing low, the higher time frame swing low, at this point, if you look left, you may find an M15 zone, your medium time frame zone within the higher time frame. So remember, as soon as you get a medium time frame POI, that's when you're technically allowed to look for your lower time frame execution, okay? It doesn't mean you have to, it's just that's the bare minimum, right? So if you're, let's say you're following the day plan, you cannot look on your execution time frame until you have hit that M15 POI. So here you may hit it. Now, do you want to jump on the lower time frame straight away? Maybe not. Maybe you do, okay? This is going to depend, right? On your own aggressiveness, how things look. It will come with time what you want to do, okay? If you want to be a bit more conservative, what you can wait for is an M15 shock, right? So at least you see some structure shifting in your favor. And what will that do? That will give you a new M15 POI. Okay, now we have a bit more confirmation. Let price pull back into it. And again, what can you do? As soon as price jumps into your M15 POI, then you look for the M1 entries, right? You're not looking for M1 entries here necessarily. You want to wait for it to come in and mitigate, okay? Now as price comes up into here, now remember at this point, your M15 is still bearish, okay? Because that was the last break of structure. This is just a chog. So there is every possibility that price could mitigate here and it could continue down and perhaps the higher time frame may switch bearish. But it's low probability at that point, right? Because we expect the higher time frame to take control. So now at this point, you may not want to short here. You may just want to leave it alone. Maybe you want to get in for a quick move. Again, this is going to depend on how aggressive you are. You see, trading is ultimate freedom of expression. You can do whatever you want here. Some people will take this, they'll take for an aggressive quick move. Some people realize it's not worth it and they'll leave it alone, okay? So let's say we're patient, we leave it and we see what happens. Price then confirms that the M15 has now shifted bullish, okay? So this becomes now our new strong M15 low and we can draw that across and then this becomes our M15 high. So now what is our immediate bias? Remember, you always want to ask yourself when you're at the chart, when you're looking at your medium time frame, whether it's the M15 or the 4 hour, what's your immediate bias? Well, now it's bullish, okay? So when it's bullish, what do you want to be concentrating on? You want to be concentrating on buying. Where do you want to buy from? Well, I can only buy from my medium time frame POIs. So there's a medium time frame POI, and there'd probably be one down here. I haven't drawn it on. So now you have a couple of demands on your medium time frame to look for, right? M15 demand. And I simply just wait for price to come into it. My alert goes off. Now what do? Now I jump down to my lower time frame execution and I look for my entry model, okay? So do you see how it's the same framework every time? Again, appreciate there's a lot going on and there's so many different ways in which this could look like in the market. But the whole time what you're doing is you're going, knowing what your medium time frame is, the M15, finding what range you are currently in for that time frame. Okay, we're bullish. I want to concentrate on longs. So I want to look for M15 demands and maybe there'd be one here as well. Okay, set my alerts, wait for price to come in. Then I look for my lower time frame execution. That's the framework. Now, again, doesn't mean you just trade every single M15 POI, right? You're going to have to learn how to do POI selection, look for ones that are maybe stacked with 4 hour zones, look for ones that are in the discount of this range here, right? And we're also going to obviously, you're going to learn liquidity concepts, which is going to be another filter, right? Things like that. Likewise, when this is bullish, right, you could technically look for the shorts from old supply. But remember at this point, if you're shorting, what are you doing? You're trading against the M15 now and against the 4 hour chart. So there's no guarantee that this POI is hold. Sometimes price could come in and then just literally blast through, okay? But again, if you want to be a bit more hands-on, a bit more aggressive, you could jump on the M1 as soon as price gets in here and look for the entry model, right, to play a quick pullback play. Then look for the long in here and now you can target a lot higher, right? It depends on how active you want to be. But the high probability ones are always going to be when you're trading in line with your medium time frame as a minimum, and even better when it's also in line with the 4 hour chart. So like this one is really good because the M15 is bullish, right? That's our bullish range. That was the last break of structure. But what is it also? It's also in line with the 4 hour chart, okay? Because remember, what do we expect with structure? That internal structure shifts bearish to facilitate the 4 hour swing pullback. Then when it shifts bullish, what do we expect? We expect these strong lows to hold, right? To be respected until we take out the high. And rinse and repeat, we get another M15 boss, right? There's some old unmitigated supply to the left. So you could technically look to play that counter trend short right on here if you wanted. Maybe you want to be patient, wait for price to pull back into, you'd have your strong low down here. You've got a decisional here. You're not sure which one price is going to come into. So maybe you want to jump into the M1 as soon as price comes in. Maybe you're not sure about this POI because you think it's going to come to the lower one, right? So maybe you want to wait for a bit more confirmation. So M15 then reacts, forms a flip. Okay, now you've got another one that's confirmed this level down here. Price comes into your M15 POI and you can jump down, okay? So you can imagine how many different variations there could be, right? I can't draw a diagram that's going to cover for every single scenario. And that's not the point. The point is to understand the framework. You have your higher time frame, okay? Objective, right? So that way it just really helps you to understand how your medium time frame is most likely going to behave. That's what the high time frame really helps with. Like I was saying back here, right? You could keep following your medium time frame. Like you could keep looking at buying these M15 POIs. But if you know that as soon as you come into here, right, this could be a strong low on the M15 and you could be thinking this is high probability to buy. But if we've just mitigated a higher time frame supply and we're overextending the higher time frame and we're expecting that pullback, that's why it really helps to have that higher time frame. Then once your medium time frame shifts bearish, okay, now you know you're playing the higher time frame pullback phase. So now you want to focus on trading shorts from supply. And perhaps this is where you're really happy to trade against the 4 hour chart, against your higher time frame, because it's the start of the higher time frame pullback, right? But once we get down into the higher time frame discount, these trades here, yes, at that moment it's in line with the bearish M15 trend, but this is a very different trade to this trade up here, because they're both in line with bearish trend, bearish M15, right, from M15 POIs, But this is at the start of the 4-hour pullback in the 4-hour premium where you're selling. Now you're in the 4-hour discount, you've come into the previous 4-hour demand range, and there's every possibility that could happen, okay? So it's all about understanding that you want to trade in line with your medium time frame, ideally always pro your medium time frame trend, or at least order flow from your medium time frame POIs. But when you have a good understanding of the higher time frame as well as of where you are in the higher time frame, that can really help you to know when to just leave trades alone. Sometimes it's not worth it, okay? And yeah, so again, if I could base down, simplify, like my strategy is I trade M15 ideas, M15 zones with M1 timing, with M1 execution. But knowing when and when not to trade an M15 zone, a big part of that is understanding your higher time frame and where you are within it. And all of the other concepts we use, premium discount, liquidity concepts are a big part of that, what we're going to learn as well. Okay, so watch this video again and again and again. We'll keep going over it. We'll go over this again in the trade plan module when we introduce liquidity concepts. For the majority of you, we're always going to recommend, even if you're advanced, that you start with this style, okay? Because if you get good at this, then you'll have a much higher chance of being good at this, because having success at trading on the M1 and lower time frames, it's hard. There's no beating around the bush, it is hard. But the only way I see people have success with this is when they understand how to pick the right timeframes in the medium time frame, POI selection, and that's first going to come from this. There is quite a lot of truth to the saying that the lower the time frame you go, the much harder it is. There's a lot more noise, and you have to have a lot more attention to detail and really have a good understanding of the higher time frames. So start off with getting good at this stuff, the swing style, and then if you want to, introduce the day trading style. Okay, but yeah. Let's have some fun with the liquidity concepts, okay? It's going to get quite technical at times, especially when we get into the liquidity entry models. But I think if you can start to wrap your head around this idea a bit more first, it will really help you to kind of hold on to what it is, what we're actually trying to do here. Now, one last thing I'll say just before I forget as well is there won't come to a point where you always have to just, only take that initial entry from, let's say, the M15 POI on the M1, right? That's always going to be the highest probability. Again, from an M15 POI, super high probability in general, right? Now, this part of the leg here, right, on the M1, if you imagine on the M1, right, there's going to be loads of like pullbacks here on the M1. Now, can you take these? Yes. Okay. So it's not that you can only trade from within here, but that's what we recommend. These should be your textbook, what I call bread and butter setups. That's the ones you should focus on. And at times, when risk reward is on your side, when order flow and everything's aligned, and there's clean setups on the M1, yes. Or if you're doing swing, you can keep following the M15, and there will be more entries, right? But these are the ones where the circles are. Generally, that's where you want to be focusing on. Alrighty, so we've gone through the overall sort of high level trade plan. Well, in some detail, it's not super high level, but you guys got hopefully started to get the picture of what it is we're trying to do. So kind of before we dive into the actual liquidity concepts, it's probably useful to actually kind of roughly see what that plan looks like on an actual chart. Now, this isn't going to be that in depth. I'm not really kind of going to properly go through this in detail, but I kind of just want to show you loosely and quickly kind of what we're trying to do here. But we'll go into this in a lot more detailed walkthroughs and really dive into trade plans in later lessons. So for instance, let's kind of first look at an example if you're taking more of that swing trading approach. So you are going to be entering on 4-hour POIs with M15 timing, right? So this 4-hour range, I won't bother doing the daily analysis just for the sake of keeping it simple in time. And you would have, you'd be looking at the unmitigated POIs here. So we can see with the benefit of hindsight that one got swept and we just ended up rejecting the range. But that would generally be the idea, okay? So there'd be likely some 4-hour supply to the left. So after a break of structure, you would be looking for price to come into here, and then on a lower time frame on the M15, right, looking to see if we get those M15 entries to play that 4-hour pullback, right? This was price action in the end of the year, so it's typically slow and corrective. But yeah, we then come down into the 4-hour POI. So at this moment, if we think there's a decent probability that this could be the move that continues, what do? We jump down to the M15 and look for your entry models, right? That's what you would do at that time. Okay, so we end up hitting a refined M15 level within here, right? So now you've done what? Now you have hit your medium time frame POI, right? you have the higher time frame objective potentially complete. We've had the daily pullback into 4-hour demand, so now you're looking for your lower time frame execution, which is your M15. Okay, again, not going to get too caught up in entry models, but very quickly we get the mitigation, we get the shift in structure, we get the V-shape reaction. Right, you have the flip, react in there, and then we get the continued movement. Right, and that would be your trade. Targeting to the upside. We're not going to get too caught up in management and things like that. Okay, ends up not working. We come down a little bit lower, and where do we come into? We come into the 4-hour extreme. Okay, so now again, what do we do? As soon as price mitigates that level, our alert goes off, jump down to our execution time frame. Okay, and then you look for your lower time frame entry model. I'm not going to get into the details of it, but you can generally see, right, structure shifts in our favor down into the demand that caused it, and there's your trade. And now what you can do is potentially target all the way up to the week high, right? Because we've had the pullback to our POI, we've entered that POI with our lower time frame execution model. So now there's a high probability that pullback is now over, and now we can target the week high, right? That's the general idea of what we're doing. Now, of course, there's a lot of other stuff that can happen in between. We can look for, continuations from within here. We can look for counter trend moves, but that's sort of the bread and butter stuff of what we're trying to do. Okay. Sort of another brief example where, again, it gets a bit more complex, where we can get complex ranges, and especially if you're taking more of that day trading approach, where we have this 4-hour range here, right? Break of structure. We've come into deeper into 4-hour supply, so we can look to play that swing pullback into 4-hour demand, right? To then potentially look for the move to go. So imagine this is our higher time frame. So when we're trading here, we would then follow the M15. We would look for the M15 to switch bearish, right? And we would look for that to stay bearish into the 4-hour POI. And then if markets were nice and easy, like sometimes they can be, but rarely are, price would then mitigate our higher time frame zone. Our medium time frame, the M15, would then switch bullish, right? And then we would hopefully follow the M15 strong lows until it takes out the high. But as you're about to see, it can get a little bit more tricky than that in reality. And then eventually we come in, and then that happens, and then eventually we go. Okay, so 4-hour would then be our higher time frame. So then if we drop down to the M15, again, I'm not going to go through this in exact detail now, but just to give you a rough idea of how markets can move, which I'm sure some of you are aware, right? We come into, or we get that break of structure. So down here is our M15 swing low. It's quite a big range. We get an internal pullback. Let me just change color of this. All right, we mitigate our extreme refined M15 POI within our 4-hour POI. Now, technically at that time, you could drop down to your execution time frame, say the M5 or the M1, and look for entries. But probably with a lot of momentum and everything, it can just be best to be patient, right? In this instance, you could wait for an IBOS, right? So again, not going to go into too much detail, as tempting as it is, but we get a reaction from demand, we push up and we push down. So now we have a big flip. But more importantly, the structure is bearish, right? The internal structure for the M15. So now you have a strong high and you have a weak low, right? So price pulls back up, we can look to short. As soon as price comes into our M15 POI, drop down into the M1, right? And then from within here, there'll be M15 POIs that can form. And each time you can look for entries on the M1 to try and follow that order flow to do what? To target that weak low, right? Then we get another M15 boss, but where have we come into? We've come into a refined M15 POI within the 4-hour demand, right? So remember the higher time frame objective, it could have now pulled back, and now the 4-hour chart may be ready to make that higher high. So what do we expect? Then we expect that the M15 internal structure can potentially shift bullish, which is what ends up happening, right? So you can look for M1 entries from within here, right? And we get M1 entries within these POIs, right? All of these, there's little, order flow within here, M1 entry, right? Break of structure, M15 POI, M1 entry. Not saying you should take all of these or that high probability, that's what we'll get into, but it's the general idea of what we're doing, the direction and the order flow and the higher time frame philosophy of what it is. So then we get that bullish IBOS, right? So now the internal structure is aligned. This is now a strong low. We come into old supply. What is old supply? It should just be reaction points for pullbacks. So as soon as we have our medium time frame mitigation, our M15 POI, what can we do? We can jump into the M1 and look for shorts to play that pullback, right? Again, we can play this whole move. Look for shorts from within here. As soon as price comes in, jump in the M1. Now we come into demand near the strong low. Now what can we do? Now we can look for longs, right? Or wait for M15 to give a bullish chop, come in here, look for longs on the M1, come up, look for longs on the M1, right? As soon as we come back into that M15 POI, right? Then we take out the weak high and we pull back again into demand. Look for longs on the M1, right? Mess around, try to break the highs, sweep liquidity. We're at least expecting an M15 pullback now, right? Again, screw out. And I'm going a little bit quick here, but I don't want to kind of get too stuck in the detail here. But again, we have that internal structure. We sweep, bearish structure here, M15 POI, jump in on the M1, come down, up to M15 POI, jump down to the M1. We're just playing the pullback. We would expect that low to hold. It doesn't. Well, as we get into liquidity concepts, you'll see as we see all these sweeps, external range liquidity and all that fun stuff, we have reason to believe this low may now go, which it ends up doing. We now get a bearish IBOS. Okay, so now this becomes a strong high. We look for price to pull back up into our M15 supply zones, jump into the M1, right? Look for shorts, price pulls back into M15 supply, jump into the M1, target the weak low. We get a break of the low. Okay, but we're coming back down into 4-hour demand. So again, there's an increased probability the 4-hour could take over and we could switch bullish. The internal M15 internal structure does try to shift bullish. Old supply becomes reaction points for pullbacks. Again, we can look for shorts in the M1. Perhaps we can get long on the M1 here, right, to try and get the continuation. It ends up failing. We are in a big, messy range at this point. Again, not getting too lost in detail. We then shift bearish again. So this then becomes technically a strong high. But where are we on the higher time frames? Remember, the higher time frame is king. We've now pulled, deeper into that 4-hour POI, right? Refine M15 within here, look for M1 entries. Come in, flip M15 demand, look for M1 entries, right? You can even look to play the move, the short from within there, right? Depends on how active you want to get, right? Back into M15 demand, M1 entries, back into M15 demand, M1 entries, right? You could even be aggressive within this level, look for shorts from within here, demand holds, flip supply, back into here, look for M1 entries, right? It's not saying, again, none of this is, you shouldn't just be trading every M15 POI. There's going to be a lot to this, right? And this is a particularly advanced and tricky piece of price action. But it's just showing you the kind of, I'm trying to keep it to that kind of high level framework of higher time frame idea, right? Pull back into here. It doesn't always just happen smoothly, and then we go. But that whole time, whilst that's in the back of my mind of what's going on, I'm trying to use the M15 structure as like sort of my immediate bias. So we're within this bearish range, kind of want to focus on shorts from supply. But that doesn't mean you can't look for longs from within here. It's just they might not be as high probability. Then when we get short from within here and we start moving down, target the weak low, right? Come into here, you can look for longs in case that's the movement, so on and so forth. So it's M15 ideas, M15 POIs, lower time frame execution, but being aware of the bigger picture of the higher time frame will more often than not help you to understand how the M15 or your medium time frame is going to behave. But yeah, we will really dive into all of that really slowly. Okay, I've deliberately kind of gone over this at a quick pace, but it's just so you can kind of, like I keep saying, have that kind of high level grasp of the general philosophy of what it is we're trying to do before we now go and dive deep into the source. Liquidity. All right. So some of you may remember this diagram from the start of the technical analysis module. And I'm not going to go on a big rant about this, but essentially this is where I was trying to preach to you that my belief is market structure is king, or at least with the way that we trade. It's what you need to nail first. You need to have a very, very good understanding of it, because that is the bare bones skeleton of our framework, of our strategy. And we need to have that completely solid first. We build that solid foundation, and then everything else, all of the other concepts, we kind of layer on top and we go from there. So, whenever I'm looking at a chart, whether it's a blank chart or whatever, the very, very, very first thing I'm doing is thinking about structure, right? I'm mapping from the higher time frames, my swing high and my swing low, then the internal and the fractal, whatever, right? And you work your way down the time frame. So you're always starting with structure. Once you have your structural ranges in place, then what do you do next? Then you add in those supply and demand zones, right? Within the current swing range. And that's what we've added in next, okay? So hopefully by now, okay, you don't have to have those mastered, but hopefully you've got a somewhat decent grasp of both structure and then how we integrate supply and demand onto and within our structure. And now obviously what we're going to be looking at, right, is liquidity. So liquidity, it can be a concept that can, again, probably be a little bit overwhelming, particularly when you go into it. You can get a little bit lost in the source with this. It can get a bit technical at times. It can be a bit subjective at times, depending on sort of how you view it and how you use it. The theory behind some of it can get a bit wishy-washy. So I'm going to try and do my best to kind of add in layer by layer by layer, and we'll build it up. And then hopefully by the end, my goal is to, because this is what my goal is with my own trading, is to introduce it in a way that is as mechanical as possible, so we know exactly why we're using it and how we're using it, to essentially just improve our edge that bit more. And kind of the main way in which we use liquidity is to help us refine the POIs, so the supply and demand zones we're trading from, and that's pretty much it. So it's knowing, it's just another filter, right? It helps us to know which supply and demand zone to trade from and what to look and wait for with our entry models when price is there. Okay, Once we then nailed all three of those, then we'll start to again really dive deep into those entries and then eventually management. Okay, but this is the order in which we need to have sort of those things, learn. And again, I'll just end it on this. Whenever you have your price chart and you're not sure where to start or you've got lost, just delete everything. Start with the structure, know what range you're in, add in your supply and demand, then use your liquidity concepts to refine those POIs and to know what you want to wait for when price gets there. Liquidity concepts will help with that. And of course, that then leads you into your entries. And then once you're entered, then you can think about management, right? That's the order in which we do things. So liquidity is essentially, like I said, it's a concept that can get a little bit, unnecessarily overcomplicated. So we're going to try and keep it somewhat simple for our purposes in the market, okay? When we start to talk about what it is, why it is, and how it happens, we're going to keep it somewhat simple to just, have a theory to hold on to, okay? So market liquidity is essentially the amount of demand and supply there is in a market. So it's like the amount of orders, the amount of volume. And the most simple way to think about it is how much money is there at every price level. If there's a lot of money at every price level, if there's tons of people wanting to trade at every price level, then there's a lot of liquidity, right? So another definition is the ease to which a market can be bought and sold without affecting its price. So what that essentially means is if a market is very liquid, then buying and selling activity, it's not going to have much of an impact on price movement, right? Because price volatility will be very low because there's people trading at every single level. So it's going to take a lot of money to move price a lot because there's people wanting to buy at every price level, right? So then if you think about the opposite case, which would be a illiquid market, so that's the opposite of liquid, illiquid, this means there is low liquidity. So then buying and selling activity, trading, it will have a much higher impact on the movement of price, right? So price volatility is going to be a lot higher when it's an illiquid market because there's not a lot of people trading at each price level. So price has to move a far distance to find where the next buyer or seller is, right? So that's what you'll see in illiquid markets like penny stocks, or if any of you have traded altcoins and crypto, some of the really low market cap coins, they will move a lot when big orders are placed in the market. Even the housing market to some degree is pretty illiquid. So the diagram here, this illustrates what liquidity looks like in terms of an order book in the market, okay? So each of those lines, each of the red line and the green lines, they represent a price level in the market. So you can even think of each of those lines as being a pip. So like 1.112, 1.113, et cetera, et cetera. So if a market is very liquid, like it is on the left, then there will be bids and offers at every price level, but also there will be a large amount of volume at each of those levels. So you can see that by the money there, right? 5 million at each price level. So it's a massive amount of supply and demand at each price level. That's what a very liquid market would look like. So if you've ever clicked buy or sell with a market order on, say, euro dollar via your broker, so you just click buy and it will get you in the market straight away, you will pretty much instantly get filled at that current level. And the reason why is because it's an extremely liquid market. There will pretty much always be enough liquidity on the other side of your order to instantly fill your trade, right? Especially if you're a retail trader and you're not trading tens and tens of millions, you're pretty much going to get filled straight away on a very liquid instrument like euro dollar. However, with illiquid markets on the right-hand side, there may not be any bids or offers at certain price levels, and or the quantity, so the amount of volume of supply and demand at each of those levels might be a lot lower too. So that diagram on the right, you can see some of those gray dotted lines just to show that there's no volume at that price level. There's no one with an order there. No one wants to sell or buy at those gray dotted lines. And you can see the numbers, so 500,000 is a lot lower than 5 million, right? So there's a lot less supply and demand in that market. So like I was saying, a typical example of an illiquid market would be the housing market, right? So if you put your house up for sale, there's not going to instantly be someone immediately outside your front door ready to buy with your exact asking amount in cash, right? That doesn't happen. Whereas in the FX market or in a liquid market, when you click sell, generally there's going to be an instant buy and you get matched straight away. So in the FX market, if there was illiquid market conditions, this is where you will often see price gapping and moving aggressively to fill the next best available order. So this is kind of a key thing to think about. For every buy order in the market to be filled, there must be, it must be matched with an equivalent sell order, and vice versa. For every sell order in the market to be filled, it must be matched with an equivalent buy order for a trade to occur. So that sentence is super important for you to understand the concept of inducement, which we're going to look at later in this module. So I am going to repeat that sentence. For every buy order, there must be an equivalent sell order for a trade to take place. And for every sell order, there must be an equivalent buy order for a trade to take place. Okay? Because otherwise, no trade can take place. If you want to buy at, say, the price was $2 and you want to buy at $2, if no one's selling at $2, then how can you buy it? There's no one to sell to you. So if you're buying and there's no one at $2, then there might be a seller at $2.20, and that's where you're going to have to go up and buy, okay? So if there's no seller, then you can't have a buyer until you both agree on a price, right? Pretty basic stuff, but this will help you to really understand some of the concepts later that some people kind of sometimes struggle to get your head around. So this diagram shows an illiquid market. So remember, each line represents a price level in the market, and at each price level, there is an amount of resting orders, so resting liquidity ready to be filled. So if you were trading this illiquid market and you placed a market buy order of $700,000, right? So you're entering the market at the current market price. And remember, when we buy at the ask price. Okay, so we have to buy at the ask, and that ask is the first red line there. We cross the spread and we have to buy at the ask. But if we are looking to buy $700,000 of whatever instrument this is, but there's only $500,000 at the current ask price level, what do you think is going to happen? Well, if you press buy for 700,000, you would instantly absorb all of the liquidity at that nearest ask price, and price would continue to shoot up another 5 price points until all of your demand had been absorbed by the available supply in the market. Because you're buying $700,000 worth of this asset, but there was only $500,000 worth of volume being sold at that current price. So you instantly get filled $500,000 at that price level that you wanted, but to fill the remaining $200,000 worth of your order, price has to keep moving up and up and up and up, right? Until it finds that remaining $200,000 worth of orders. And that's where we end up there at the top of that price level. So price is constantly seeking liquidity to rebalance price. So when we see those large imbalances between supply and demand in the market, remember this is what we've been doing the whole way through the supply and demand module, where we've been looking at those zones on our price chart so far. That's what's happening, right? We are viewing this process on the order book via the price action, via candlesticks. Because when price is moved by that imbalance between supply and demand, it will then keep moving to seek liquidity to then rebalance price at what it deems to be a fair value. So that's why you see the market move impulsively in one direction, whilst it seeks that liquidity to rebalance price. And then you see the market move correctively. It moves sideways until another imbalance is created, right? When those large orders step into the market that then break price out of that range, and then price starts rapidly moving to another direction. And then what is it doing? It's seeking more liquidity, more orders, more money in the market until it's rebalanced again, until supply and demand kind of even each other out for a little while, right? And then we'll see that corrective sideways movement whilst the market deems it to be at fair value. That is the heartbeat of the market. So the aim of the game that we are playing by using technical analysis is essentially using all of these concepts as a mechanical framework to read what is happening on that order book. But we don't have an order book, right? So how do we do it? We do it with the price action on our candlestick charts, okay? So again, we're using technical analysis tools, the tools that we use, to try and read what that order book might look like, but we're just doing it with our candlestick charts. So we spent ages looking at market structure. And what is the purpose of using market structure? Well, we use it to help us with direction. So whether price is bullish or bearish. We use it to see if we are trading with or against the trend. And then how that all fits together within the multi-time frame story, right? When we build that higher time frame narrative from the daily, the 4 hour, the M15, et cetera, how that all pieces together. We also use market structure to see how well something is priced within the range, right? So we use premium and discount. Then we looked at how we can use supply and demand zones. And what does this do? This shows us where potentially large orders have entered the market, because that's where we see price causing those huge imbalances that rapidly shift price to make it move in one direction. And therefore, when we draw those zones on, that signals that potentially there may be some orders left sitting there. So then we can use that to our advantage when price returns to those zones, right? So a simple way to think about supply and demand zones, it's just to think about where did big money step into the market, right? We're looking for those footprints of institutional money on the chart. And that's what those supply and demand zones show, where those big imbalances in price occurred. So now the next tool we're going to be adding to our arsenal of weapons is to help us identify where large pools of orders may be sitting in the market and where price may gravitate and move towards. And that's using liquidity concepts, okay? So we're going to hop on the charts, so it'll be a bit easier to visualize. But if you literally think of that supply and demand zone, right, the way we looked at it, price is ranging, and then price breaks out of it to the upside and starts rapidly moving in one direction. What that is doing is it's then searching for where the next level of supply and demand is going to be, right? Where those pools of orders are going to be, and liquidity concepts are a way in which we're going to be able to sort of anticipate that, okay? So liquidity in the market, you can kind of think about it as acting as a magnet for price to be attracted to, okay? It will start moving in the direction of where the next big pool of liquidity is going to be, because after those huge shifts in supply and demand that have caused those imbalances in the market, price is then constantly seeking the next available liquidity pool to tap into all of those orders to rebalance price, right? To make supply and demand more equal again. It kind of helps to think about it that way. And then it will tap into that liquidity pool, and that will provide the fuel for the next market move in whatever direction that's going to be, okay? So identifying liquidity in the market, it can obviously be a very useful tool for us to use in our analysis. But if we're not looking directly at that order book, right, that we just looked at, then how can we spot where there is liquidity lying in the market on our price charts? So that's what we're going to look at next to kind of see, how we can hypothesize where those resting pools are going to be. Alrighty, so we started to cover the sort of basic theory behind liquidity and how we're going to think about it within our trading. And a sort of super and crude quick recap of the previous lesson is that, essentially when you're looking at your price chart and you've got all of, every single price level over here, in a liquid market, at every single price point, literally every single micro pip, there's going to be a ton of supply and demand. There's going to be a ton of volume. There's going to be a lot of market participants ready to trade and transact at every level. So when you have a high amount of liquidity, it takes a ton of volume in order for price to actually move and absorb all of those orders, right? Whereas if there was an illiquid market where there weren't a lot of orders and it was a bit more a bit more bare, then if a big market participant starts buying in here, he's going to quickly absorb all of that supply, right, until he gets filled all the way up here, okay? So liquidity is essentially where we are going to be looking for, I'll explain this in a lot more detail as we go on in the other lessons, but it's essentially where, if you're a big player, right, you're going to need a lot of liquidity to enter and exit the market without minimal slippage. You're going to want to be looking for those points in the market where there are a ton of orders. We don't have view of the order book. Okay, and also FX is OTC, over the counter, right? There's no central exchange. So how do we do it? How do we read it? We read it through the price action on our charts. Okay, so same way with supply and demand, we're not looking at the order book. We are looking at where those orders came into the market that did something significant, right? Broke structure, or ones that, flipped another zone like that, right? Then that's a strong supply zone. And then we can have some general assumption that within this level here, because it managed to overpower supply or because it broke some structure, that these two zones could have a lot of orders within them, right? Where price may tap into it, fill those orders and continue the move. So that's what we've done with supply and demand. Liquidity is another thing where we're going to be trying to identify on our charts, identify where those resting pools of orders may be. Because if you're a big player, right, an institution, BFIs, as people like to call it in the space, banks, financial institutions, let's just continue with that term because it's nice and easy, right? If you're a BFI, generally, you are generally going to be wanting to exit and entering the market where those pools of liquidity are, okay? So essentially, before we get lost in all the sauce with these next lessons you're about to dive into, because it can be very easy to get lost in this, okay, as we go through this, especially if it's your first sort of time, we can get really lost in detail here. But if you always try and remind yourself every time you're thinking about liquidity, it's just another tool we're using to try and identify where there may have been BFI involvement, okay, where big money may have been getting involved, right? And remember, the whole kind of general philosophy of our trading is to try and spot their footprints and to use that to our advantage to kind of be trading with them rather than against them, okay? That's kind of my philosophy of what I believe I'm trying to do here. So this lesson is supposed to be relatively simple and give you the bare bones of the sort of minimum I'm looking for in the market to identify where we make a general assumption that liquidity will be. So as you can see here, right, bare minimum, we just have a high like that, right? A pivot point in price. So on a candlestick chart, that's what I would need to see, right? So the same way we look at fractal structure, where, each candle breaks the previous candle's high, and then as soon as the next candle fails to breach that candle's high, we've had that pivot in price, right? We've had that pullback. That is now a high in the market, and we can assume that some liquidity, there'll be untapped liquidity above that high, right? Because what's happened is you've got orders all here in the market, and as these candles move up, what are they doing? They're filling that order. They filled all of that supply, right? They filled all of that supply, and then they come up to here, and then this order now hasn't been tapped into, right? And then prices started trading back down, and it's filling all of the demand that was left here, right? So this untapped order, or the amount of, to be more accurate, the amount of supply that has not now been used, that is resting liquidity, right? Sitting above that high here, right? So that's why we then use, or if you do it like me, I just use a line with a little X on it just to show resting liquidity there, or we assume there is resting liquidity, okay? And that's the bare minimum. And then the same thing for a low, right? So you get that pivot in price. You would have all of this demand here, right? Price is trading through it. It's absorbing all of that demand. It uses all of those orders up. And then at some point, price will pull back. So now you have those untapped orders down here, right? These have not been tapped into. These have all been taken. And now we assume there is resting liquidity below that low, okay? And then everything just stems from that pattern, either a low or a high, and then you can just build it from then on, okay? But it's just basically wherever you see a low or a high, we can assume there is some liquidity. Now, how much liquidity we can assume is resting there, we can get into a bit more in the following lessons, right? And we'll look for things like this, okay? I'll touch on it now, like where if you just have a high like this, okay, maybe it's a weak high, didn't break any structure, there might be some liquidity behind it. Whereas if you have a high that actually achieves something significant, there could be a lot more liquidity, or we can assume there may be a lot more liquidity behind that high because a much more significant thing has now happened in the market, okay? And what do you think is going to happen for people who are trading this, right? So if someone's already short, where are they going to have their stop loss? They're going to have their stop loss behind that high, okay? Now, if you are short and your stop loss is behind there, what order is your stop loss in the market, right? If you've sold and then price stops you out, what do you have to do to exit your position? You have to buy, right? So when you're short, your stop loss is a buy order, okay? So when you see a high like this, that's broken structure, we can assume there's probably been a lot of market participants who have sold, right? Or what else may happen? When price comes back up, okay, people might want to sell the double top, right? And that's when you'll get patterns like this. So then that can mean there's even more people selling now, right? And there's more stop losses behind here, which means there's more buy orders, right? There's buy side liquidity building up behind highs, okay? Because again, if price comes up and you get stopped out and you've sold, what do you need to do? You need to buy back your position. Now, what's the other thing that can happen when you get this is you can get breakout traders, right? They see that seems like a strong level. If price breaks that, we're probably going to go to the moon. So they want to buy. Or some of you may know bull flag patterns, right? Where you get an impulse correction. And then the next idea is that you get that next impulse. What are people going to do? They're going to buy that, right? So what do you get? More buy side liquidity. So, okay, so whether you've shorted or you're buying, it's a lot of buy side liquidity above those highs, okay? And that's what we assume builds. It's the same with the trend line, okay? Or whatever way you want to do it, kind of a retail pattern. Price comes in for the touch, get short, or 2 touches confirms the trend line. What do you learn on YouTube? Okay, let's sell the 3rd touch and let's get short, right? Or even if you're a supply and demand trader, like we are, right? Break of structure, come into supply. What do? We look to sell, right? And then stop losses can be above the high. And again here, we can look to get short, more stop losses can build, right? So this whole time, what's happening? Buy side liquidity is building up behind those highs. Okay, my stop loss is a buy order to buy back my position. And then the exact opposite for the lows, right? Let's just do 1 or 2 examples just to speed this up a bit. But yeah, we have a support floor. If you're long, where's your stop loss going to be? It's going to be below. And your stop loss in this case is going to be a sell order, right? Because if you've bought to get long, if price then stops you out, what do you need to do? You need to sell your position back to the market, right? So that's a sell order. Again, if you buy all of these lows, what happens? Tons of sell side liquidity starts to build up below those lows there, okay? So we get what we call sell side liquidity below the lows and buy side liquidity above the highs, okay? Now the importance of this, it will come later in terms of how we actually use it to formulate trade ideas and use it within our trade plan and our strategy and our entry models and all of that fun stuff we will get into. So for now, I kind of just want to get your head around the sort of basics, how we, basically what I want to do now with you is get very clear on what our definitions are, okay? Especially when we look at sweep zones, we'll look at the things individually. And then as we go through, we're going to start to put all of the pieces of the puzzle together again. And that's when we might get lost in the sauce a little bit, right? So let's try and build up slowly, and we'll get there. But let's just now go have a look on the charts at some sort of basic liquidity identification. Alrighty, so now we're going to actually look at a real chart. How do we identify where there is resting liquidity in the markets? Where are those resting orders? That untapped money that may be sitting there? Well, remember the bare minimum definition of where I will start to or anticipate that there is liquidity sitting below the market is when you actually have a low, right? A fractal high or low. So I won't be drawing on this time frame liquidity below the low of the candle. It needs to be this actual low here, okay? So again, I wouldn't draw the liquidity below that bearish candle because price is already tapped into it. It's not a structural low. This is where the low is. Likewise, that's where the high is. There's liquidity behind there. There was liquidity behind there. Just zoom out, right? That's the structural high. We move down, liquidity gets left behind there. There's untapped orders behind that structural high, and then price moves into those liquidity pools, okay? So this is, or what I'm gonna do in this lesson is not really anything that systematic or that you're gonna be directly sort of implementing into your trading or trade plan. This is just kind of gonna be a very loose way of just scrolling through the charts, showing you where liquidity is and kind of just getting your eye for it. And like I said, as we go through the next lessons, that's when you'll learn okay, how do we actually now implement this and make it as a tangible piece of the systematic framework that I use and put it into your trade plan, right? So without kind of even drawing on structure and supply and demand zones, you can just zoom out and you can see what's going on here, right? Like we have, all of these relatively equal highs building along here. So we almost get that support level, right? People selling every time we come up here. Again, support and resistance traders going to be getting short. Tons of liquidity is building up here. And eventually we get that aggressive breakout to the upside as all of that buy side liquidity is tapped into. And then we get that aggressive retrace to the downside. And if you zoom in and kind of take that move apart a little bit within here, what do we have? We have that ascending trend line, right? That trend line liquidity building below those lows. So we know there's a ton of resting sell side liquidity below there, a bit of a mouthful, and then price comes down and taps into those orders. Then we've got relatively equal lows here, right? Another support level. What do we know? There's resting orders below there. So then when price comes all the way below there, again we get another bounce here, just generating even more liquidity. We get that triple bottom, people getting long, have their stop losses below those lows, and then price taps into that orders, it rebalances price, and then we get the pullback, right? So that's why we say every time we have a break of structure, what do we typically expect? We expect the pullback as that resting liquidity is then tapped into, right? Same thing again here, start to build a bit of a range. We get sort of these triple bottom lows, tons of liquidity starts to build below that, and then eventually we get the breakout of that. Then what do we leave? We leave these equal highs here, tons of buy side liquidity is left above there, right? And eventually price will come up into there, and as price takes out those highs, just tap into it, right? Belly doesn't have to be a big tap, just enough, and then we start to see a bit of sensitivity as that buy side liquidity is tapped into. Even on a more granular level, if you really zoom into price, let's take a look. What do we get? Or even down here, right? We get that ascending trend line, people buying that trend line high, and then we get liquidity resting below that. Now, just because liquidity is there, we never know when it will be used, when price will tap into it. We just know that it exists, and at some point it may be used in the future, because as we can see, right, the trend continues to the upside. We have a fractal low here, so yes, that to me would be liquidity sitting below that low. As we can see, as soon as price just trades just below that, we get a sweep, and then we move to the upside. Resting liquidity above that high, what do we get? We get a sweep, and then we pull to the downside. Then we get a sweep of the resting liquidity below the most recent low, right? And then that fuels the move to the upside, right? So we'll talk about this a lot more in near future lessons, where we talk about sweeps of liquidity and how that can generate the continued moves. But essentially, when you see highs and lows like this, especially when they're kind of near each other, you can see you have that boxed off range. So people selling the breakout of their range, they get short. What happens? They get smashed as price trades back into the market. Likewise, people buying the break of this high here, if they got just tapped in trying to buy that, price trades in. So you get a lot of manipulation when that can happen. Likewise, price comes up here, we get a bit of a pullback, we move up, we failed to break the high. So this is a good example of relatively equal highs, okay? It doesn't have to be like a perfect double top, but you can see there's a clear move up, and a clear move away, right? So you've got those relatively equal highs. This is kind of how I personally would annotate in the market. You can just leave a line there with a little X in it. Typically what I'll do, if I can be bothered to do it or if I remember to do it when I'm marking up my charts, is I'll just do that to show that the liquidity hasn't been tapped into. And then when price does move up and tap into it, that's when, again, if I can remember or be bothered, I'll put it in the middle to kind of show that the liquidity has been taken. Likewise, we can see price then comes back down, sweeps the resting liquidity below that low, and then we get a movement to the upside, right? Then price starts to pull back, we start to build that descending trend line liquidity, starts to build up here, price then comes in, takes the liquidity above the high as well, fills up those orders, and then we get the pullback. And what did that move leave? It left relatively equal lows behind here, right? So we've got resting liquidity there, price then comes down. Price then comes and sweeps the liquidity below this low, right? I think you guys get the drill. There's liquidity everywhere constantly as price is searching for those pools of liquidity, searching for those untapped orders to fill up, rebalance price, and then fuel the move, fuel the next move that's going to occur from there. So again, relatively equal lows down here, relatively equal highs to the upside. Price comes in, taps those orders, and then it fuels the move to the downside. Grab the orders below here, right? And then it fuels the move to the upside. But this is, as you notice, that's when we get the shift in structure. This becomes our strong high. We come into supply, right? We grab the orders and then we target the liquidity below that weak low. Okay, so we can start to bring in our other concepts and you can understand now how they all start to move together as we come in. We then get a break of structure. It taps into that liquidity below the low, fills up that sell side liquidity, right? And then buyers start to step into the market to push price back up. That's when we start to get sweeps of these internal highs, right, to then fuel the next move to the downside. Again, targeting the liquidity below that weak low to rebalance price. Price then starts to pull back again. Okay, so once you kind of start to see this, these same patterns happen again and again and again, right? We start to pull back, we start to grab the liquidity behind the highs until we eventually fill up enough of those orders to rebalance price to then get that overwhelming imbalance between supply and demand, where supply starts to regain control, and then we start tapping into all of the sell side liquidity, and eventually the sell side liquidity below that swing low there, the external range liquidity. Again, this is concepts we'll talk about more in the future. I'm kind of being quite loose here, as I said I would be, just to kind of keep it relatively simple, but just showing you what those pools of liquidity are. Again, you can see relatively equal highs there. What does price do? It comes up and grabs the orders that that pool of liquidity that would have been sitting there, if you think about it as money, grabs that fuel, and that can fuel the move to the downside to target this weak low here, where again there'll be liquidity sitting below that low. You can see even just before it gets there, nice double bottom, inducing buyers into the market, more stop losses getting below here, taps into that liquidity, and then we get the movement again to the upside. And then this whole time, what do we have? That larger trend line building up, so people can keep selling that, and eventually with that big trend line, what do we know? There'll be tons of resting buy side liquidity here, which the market then comes in and grabs, and then that fuels the next move to the downside, right? So yeah, I mean, even if you zoom out and do multi-time frame analysis, you'll be able to see loads of other things. You can even see here, right, without zooming in, we get this big range for a long time. Or do we know there'll be a ton of resting liquidity either side of that range as it's building up? So you'll get a bigger double top like that, price grabs the liquidity and then fuels the move to the downside. What do we have? The big trend line liquidity, the bottom of the range. We just know there'll be a ton of orders building below that, and then price grabs that, grabs the liquidity below the low there, right? Taps into that pool, retraces again. Even within all of that range, again, there'll be sweeps within that, right? All of these highs within here. You even get the exact high of the range. As soon as that pool swept into, what do we get? Aggressive retrace back inside the range. Liquidity sweep here, right? Taps into those orders, retraces back inside the range. Get a massive double top there, right? Loads of people who are short, where the stop loss is most likely going to be from these highs, or breakout traders wanting to buy that level because they think it's such a strong level with such a big movement away. They try and get long, and then both people who got short get stopped out, people who get long, they get tagged in and then stopped out. All that manipulation to then fuel the move there to the downside. Okay, so I'm not going to do any more than that because I think you guys probably get the idea of what I'm getting at here. But kind of just wanted to show you the bare minimum of where we anticipate liquidity being within the market, essentially looking for those untapped highs and lows in the market. And now over the course of the lessons, we're going to learn how we actually kind of put together a more systematic and mechanical framework for what we look for to add to our trade plan, namely sweep zones and inducement. So yeah, let's dive into those in the next lessons. Okay, so we've looked at what liquidity is, and then we started to look at how, we can identify where we assume resting liquidity is on the chart, or where, liquidity was and has already been swept and taken. Okay, so now we're going to start to get into the more sort of juicy side of things, where we are going to look at, how we actually use these liquidity concepts within our trade plan and how to formulate trade ideas and all that good stuff. So like I was saying before, first we're going to kind of have to strip things down into their individual pieces, into the individual components, so we just know how to identify them and what each individual component, how we interpret it. And then as we go out through the lessons, then we're going to put those all together to, put the pieces of the puzzle together right. And we're going to get a bit, fancy, and then perhaps a little bit lost in the sauce with entry models and all that good stuff. So it's good to just take our time, build things up slowly, and we'll get there. So yeah, and like I kind of touched on there, it can be very easy with all of this, and not just liquidity concepts, but the whole strategy in general. There can be a lot of variables, a lot of components, right? And it can be very lost to kind of, or very easy to get lost in all the source of it. So what I always try and do is trying to bring things back to a high level and ask ourselves is, what are we trying to do here? What is kind of the overarching philosophy of the strategy and the trade plan? And for me, what I think I'm at least doing, or what the philosophy is behind my trading approach, is to look for institutional footprints in the market. Okay, so where was the big money involvement? It's a bit of an oversimplification when I say the big money involvement, but it's just an easy way, I think, to kind of hold on to what it is we're trying to do here, right? We're trying to look for where the big guys got involved. I want to be trading with them rather than against them, quote unquote. So the first kind of way we've been doing that, specifically with sort of looking where they've entered, is looking at supply and demand zones, but not just any supply and demand zone. We want to look for where did big money enter or exit the market to cause those overwhelming imbalances in the market, right? So to significantly move price. How do we do that? Well, we filter those supply and demand zones by looking at ones that either broke structure, right? Because obviously it takes a significant amount of money to break structure. The more significant the structure, the more significant potentially that zone is going to be, or it managed to flip another strong zone, right? Where we see that interaction between supply and demand, and one manages to overpower the other, right? Where one takes control, okay? So when we've been identifying that, that can hopefully signal that there was institutional backing in the creation of that zone, okay? So liquidity concepts, they're simply just another great filter to signal BFI involvement, okay? BFI, banks, financial institutions, right? It's just another acronym in the space that's already overloaded with acronyms, but basically the big guys, right? Institutional involvement is what we're saying there. So it's just another way in which we can now apply these liquidity concepts to what we've already been looking at as another sort of tick in the box. Let's say that potentially there was big money involved in that area, okay? So now just bringing a step back to what we're talking about in the theory lesson, right? Every buy order must have an equivalent sell order for a trade to take place, okay? So obviously, like I said, if you need to buy 10 apples at $2, you need someone selling that minimum amount of apples. Someone needs to be selling at least 10 apples for $2, right? Otherwise, there can be no trade taking place, okay? So if you're a large market participant, right, you're going to need the equal and opposing liquidity to enter the market with minimal slippage, okay? So essentially what that means is, well, if you think about the order book, right, at every single price level, there's going to be, orders, right, supply and demand. And if you're in a market where, say, there isn't a lot of supply and demand and it's a bit of liquid, like you've got loads at list level, not much here, another chunk here, and then loads up here. If you're someone down here, right, and you're a big guy, let's say, and you want to buy 10,000 lots, what's going to happen? It's going to quickly absorb all of that supply, and you're probably going to get filled some of your order up here, okay? So large market participants, they need opposing liquidity to enter the market with minimal slippage, right? If you want to buy here with a ton of volume, you want a ton of volume to be exactly where you want to buy. You want a ton of volume to be selling to you that you can buy from, right? So you can transact at this level rather than getting filled all the way up here. That's essentially it. So when we are identifying where liquidity has already been taken, okay, so that's why we're looking on the price charts and we're going, okay, there was probably, if you got a low like this, right, there was probably liquidity below that low. If we see where price comes down and grabs the liquidity below that low, that's what we say grabs, liquidity has been taken, liquidity has been swept, liquidity has been run. They all essentially mean the same thing, that price has come in and grabbed some of those orders there. So when we say it's been taken in the past, and it leads to the creation of a supply and demand zone. That is what we call a sweep zone, okay? And that signals where BFIs have likely entered the market, right? And this is where we kind of get some of these patterns like this, okay? So essentially, we are looking for, in the creation of, well, let me bring it back again. When we look at supply and demand zone, like I said, right, we're just looking at one structure zones, ones that lead to a break of structure. Now, all we're simply doing is when we identify a zone, we validate it because it did break structure. Okay, so we know it's an institutional zone and it's an institutional structure zone. The only extra filter we're now looking for is we look left of the zone and we go, did it sweep any liquidity, right? And it swept the liquidity behind that high. So now we call it a sweep zone, okay? Because if you think about it, if an institution is selling here, right, and they're selling or they're shorting enough, right, to lead price to be able to break a low, that's what we identified, that potentially there was a lot of supply that came into the market, so then we can look to try and get short here, right? So we use the filter of it breaking structure. Now, like I said, for every buy order must have an equivalent sell order, okay? So if you're someone who wants to sell, a ton of volume up here, what do you need? You need someone buying, right, from you selling into. You need a lot of people buying up here. And what do we know about highs? We know there's a lot of buy-side liquidity above highs where people are either buying the breakout of a high or the breakout of a bull flag, or what's the other way? They could be having their stop loss behind the high, right? If they're short and price comes back up, what's their stop loss going to be? It's going to be a buy order, right? If you've sold your position and you're short, if you get stopped out, what do you need to do? You need to buy back your position. So essentially what we know is behind highs, there are tons of buy side liquidity, okay? There's lots of buy orders there. So if you're a big guy and you want to short and you want to sell, what do you need? You need that buy side liquidity. So it's likely you're going to enter short up here, selling into all of that buy side liquidity so you can get as much of your position filled as possible. And then that move leads to an overwhelming imbalance that causes a break of structure, okay? So it's just another filter that potentially signals there was institutional involvement in the creation of this supply zone because it led to a break of structure and it grabbed the liquidity or used the liquidity in order to enter the market, okay? That's the theory behind what we're doing here, okay? So yeah, essentially liquidity, identifying where liquidity has been taken in the creation of a sweep zone signals where potentially they have likely entered the market. And where liquidity is resting, okay, so liquidity that hasn't yet been tapped into behind here. We'll talk about this later, but essentially that's the concept of inducement, and we can signal where they will likely in the future potentially enter the market, okay? So a sweep zone is a POI that sweeps liquidity as it is created, and we assume that it's likely there was institutional involvement in the creation of the POI as they grabbed the resting liquidity to enter the market, right? So another quick few examples. A point I want to make is how much, I think I alluded to this before, but how much liquidity is behind this high, we never really know, right? But we can look at certain structures and assume that some may have more than others. So if you think about this high here, right? If you've got a bullish market like this, what did this high achieve? It didn't achieve much, right? It didn't break any structure. It's just a weak high that had a pullback. So arguably there's not as much liquidity behind this high compared to what we have over here, right? Because what do we have here? We have price pullback, breaks the high, right? So this low did its job, right? It broke structure. So you could assume that because this low actually achieved something, it broke structure, there should be quite a decent amount of liquidity behind it. So now if price breaks that low there, right? You would assume there's even a ton more liquidity behind here now because it actually achieved, it broke a strong low. So now when price comes back up and sweeps liquidity behind here, the sweep of a strong high, so a high that actually achieved something, compared to the sweep of a high that didn't achieve anything, we can assume there'd be a lot more liquidity building up behind this high. So if you see a zone like this where it sweeps strong structure, strong high or low, right? So you got this low breaks the high, that then becomes a strong low. If price now comes down and grabs the sell side liquidity below that low, we can assume that this, in theory, this zone should be stronger than this zone, right? If everything else was the same, of course you have to bring in market structure, multi-time frame analysis and all that fun stuff. But if you just had two identical zones, but the only difference was this, in theory, this should be the stronger zone because it's used likely more liquidity behind that strong high. And then likewise, same here. If we have a build-up of equal highs, we know there's going to be a lot more liquidity starting to build up behind there compared to if you just had, one weak high like that, okay? And that's pretty much it. You don't need to overcomplicate sweep zones any more than that. Kind of just a little sort of FAQ here. For me, for a sweep zone to be valid, it does not have to sweep strong structure, okay? So that's a weak low, right? If you have a trending market, it never broke the high, so that's a weak low. It doesn't have to sweep it, but this is obviously more ideal, right? Because this sweeps strong structure. So I would view this as higher probability than this, but it doesn't have to be. I would still view that as a sweep zone. Okay, and the other thing is the sweep must be vertically near the POI. So what I mean by that is like if you say you had a pullback like here, and then price comes all the way down, and then price comes all the way up and breaks this high, okay, that is a valid demand zone, right? That broke this high here. But can we say that it swept the liquidity behind this low? Well, it's miles away from me, right? So like, you know, it's probably used liquidity all the way down here. So I wouldn't say that that's a sweep zone of this level, okay? It needs to be pretty near it. Now, the other thing as well that I forgot to mention is sort of when we look at this on the candlestick charts, it'll become a bit more obvious, but sweeps usually kind of, they have what I call the nature of price action. So what you'll typically see is price will kind of come up, it'll sort of be a bit slow, and it'll kind of just grab the liquidity behind the high, and you'll usually see like a big wick and then like a sharp movement down, okay? It's kind of like slow movement up, and then boom, like the big money steps in. And usually you'll just see kind of like a big wick like that, a big wick retrace, or you maybe see like kind of one or maybe two candles close and then like boom. So it's kind of like that obvious sort of, you know, sweeping nature that you get to it, okay? So yeah, that's it with structural sweep zones, and we'll take a bit of a look at these on the charts to identify them. So 20-second recap on what a sweep zone is. It's essentially another filter that we are using that potentially indicates that a supply or demand zone was created by institutional involvement, big money involvement, because the theory is that they've likely used the available sell side liquidity below that low to enter their long positions that then leads to that break of structure, or likewise using the buy side liquidity above those highs to use as liquidity to enter their short positions to enter the market. Okay, so let's go and look at what these look like on an actual chart. Did get some requests to look at pairs other than euro dollar, which is fair enough, right? Just to show you, how these concepts are universal and can be applied to any instrument or asset class. So let's kind of just zoom in to the recent PA price action. And what we're going to do is, like I said before, at this stage of this module, we're just going to be focusing on identifying and sort of defining those individual concepts on their own. So I'm just going to look at some examples of sweep zones. We'll talk a little bit about how it's developing with price action, but for the most part, I'm not going to be getting too stuck into how we're analyzing everything together with all of the concepts and thinking about trade ideas and forecasting where price is going to go. We'll leave that for a little bit later in the module. For now, I don't want all of these lessons to turn into 30 or 40 minute walkthroughs. I just want us to get good at identifying them, and then towards the end, right, we'll put it all together and we'll spend a lot more time kind of really walking through price slowly and using bar replay and all that fun stuff. So what we'll do is we'll kind of go from here and we'll go through sort of recent price examples to where we are. Now, one thing I'll say as well, I'll just zoom out on probably to the weekly chart on pound dollar, that when you get these sort of major breaks of monthly and weekly lows, right? And we can see that price ends up having these big pullbacks up towards a strong high. And then again, we get another big, massive, basically break of that low, and you get these sharp movements. Very often the sort of nearest structural high can be quite far away when you're trading down here. So like, for instance, it might be a bit more clear on the daily, like the last real sort of clear swing pullback is all the way up there. So for all of this time when price is trading here, yes, you can look at that as your strong daily high, but typically what I would advise is just kind of focus on the more recent price action and like follow this, just because you've got such a massive swing range that, if you're trying to short every supply here, a lot of times, price is just going to react. It's just a catalyst for a pullback, right, to push up higher. Again, we'll talk about this a lot more when we come to internal and external range liquidity, but just because when I go through this, it will make a bit more sense as to why I'm going to start mapping structure, right, looking from within here. Even though, yes, I know that the last swing high is probably all the way up here. When you get these big, massive sell-offs, sweep of the low, I'm basically going to start mapping my internal structure from here and just focusing on this, because otherwise if you're just waiting to short from all of these supply zones, a lot of the time you are going to get smashed. So we kind of look down here and just start mapping that internal structure on the 4-hour chart. And we can see we had this break here. Now, what happened when we led to that break? Obviously, we have demand zones that came in to lead to that break of structure. But what do you notice? We have price come down, it pulls back up, right? And then it grabs the liquidity below that low, right? We get a sweep of the liquidity, and then that fuels the move there to the upside. So let's just draw these on. Okay, and then it's quite a big candle, so it's a bit of a messy zone, but essentially you get that large sell to buy candle with the next candle closing above it, right? Price taps into that, and then that leads to the move that then breaks structure. And then even on a smaller scale here, you see what happens. Price comes in, it pulls back, it breaks the high, right? So we know there'll be liquidity below that low. And what does price do? It comes down, grabs the liquidity, and fuels the next move to the upside. So you have another sweep zone there. Okay. Bit of a tricky one is to draw, because sometimes when you get kind of price action like that, I kind of like to include the wick as well, and I kind of just take that whole range. We get a bit of a reaction, but ultimately it ends up failing, and we come a little bit lower. We end up tapping into the previous internal demand range here, as we can see, and then we continue there to the upside. But as we pull back, right, so at this point, this would be your sort of larger internal high that you'll be focusing on at that time. What happens when we form the strong low? Well, as you can see, as we're pulling back, get that fractal structure, this low breaks the high. Okay, so we know that that becomes somewhat of a strong low because it actually broke some structure this low here. So we know that would be a fair amount of liquidity building below that low, sell side liquidity, right? Enticing early buys into the market. Price then comes down, grabs that liquidity, and now it has the fuel to make that big move, right? So the theory would be that that low gets put into the market, enticing early buyers into the market, generating more sell side liquidity. And now let's say the big guys can step in and they can use that sell side liquidity to enter their long positions. And now there's enough juice to fuel that movement to the upside. Okay, so we get another sweep zone here where we sweep the lows there, and then we move to the upside. And as we can see within that overall move, we also get a flip. So we get the reaction from supply, and we can refine that to the pivot candle in which price comes down to, right? That's where demand really regained control from supply, and we move there to the upside. And even you can see here, right back here, when this initial sweep happens, then we flip, and then we come up, we have a bit of a pullback, and we go higher. And what happens? That generates more liquidity below that strong low, right? That broke that high, and then price comes down. We get even more equal lows here, right? Another bounce, just enticing more market participants into the market, generating more sell side liquidity. And then we get that liquidation into the flip here. And then now we have the fuel to make that movement to the upside, right? So you just get another big sweep POI here, right? And then eventually that leads to the move that breaks structure to the upside. And then again, we come down to this strong low here. So hopefully you can start to see a bit of a common theme when the pro sort of trend moves, pro order flow moves. Very often those strong lows when we're bullish will form through a sweep of liquidity. Okay, so like, I don't know why that disappeared. I must have moved or deleted it, but there, we initially had that sweep here, right? So very often what you'll see is price will move to the upside. You kind of get those corrective low resistance highs. Price will come down, and then as it's sort of starting to make that what we think is going to be the higher low, very often price will come down, then grab the liquidity, and now we have the fuel to the upside, and then we get the breaker structure. And then likewise, we sort of get those corrective moves down. All right, we might build some equals, and we'll get a sweep of those potentially into the sweep POI here at the previous strong low. And then we'll have the fuel, right, as we liquidate those lows to get to the upside, right? And those low resistance highs there, that basically leaves liquidity to target, available liquidity to target at the high. And then same cycle repeats, right? We'll come down. Obviously, it can all happen in slightly different ways. You get a break of the high there, generate strong liquidity below that low. We come into the previous sweep zone, and then we go. So that's why, you know, when you've got sort of descending highs like that haven't swept any liquidity, that's where we say there's resting available liquidity above those highs there. It's low resistance. So when price is coming up, it's easy for price to target those highs, right? There's liquidity to target. But when price is pulling back down into our strong structural low, this is where we have, you know, that sort of high resistance liquidity low that formed, it swept liquidity. It's got strong demand zones that took liquidity that led to the breaker structure. And that's why, you know, we have those protected ranges, and very often price won't break it, and we'll continue to the upside and target those that low resistance available liquidity at the top, right? So you can see kind of what I'm saying here is we come up, we pull back, sweep liquidity, strong movement to the upside, right? Again, we have that pullback, get that low there, sweep liquidity, and then eventually we go, come up, generate more liquidity, sweep the liquidity, and then we go. And that will happen, you know, even on a smaller scale. Like when we come into this low down here, right, that sweep POI that swept the liquidity below that low, we initially tap into it. It's a bit of a tricky one to see on this time frame, but we come in, what do? We move to the upside, and then price comes down, and it just grabs liquidity just below that low, it just breaks it by a few pips, right? And now the movement is ready to go, and you get another sweep zone created there. Now this one's even a bit more subtle to see. Do we flip this range? Yeah, we do. So we come into the supply. But what happens, if you look at how those candles would have formed, right? Price reacts, it comes down, it pulls up, and then what does it do? It comes down and grabs the liquidity below that low. Yes, it's just a weak low, right? It didn't break any structure on this time frame. But remember, for sweep zones, we don't need it to sweep strong structure. It can sweep a low like that. And for me, that's still valid. I find it high probability, and I prefer it when it sweeps a low that actually, clearly broke structure, and even with the candle body close. Like, that's brilliant when that happens. And you can see when price came back, super strong reaction. Okay, but for me, this still meets the criteria, and this is a flip that swept liquidity. So yeah, spoiler alert for the next lesson coming up, but this is a perfect example of that, right? So we had the reaction from supply, we pushed the upside, but what did the reaction do? It swept liquidity, okay? It came down, it came up, grabbed the liquidity below that low. So the theory is, right, it signals more institutional involvement using the liquidity that would have been available below that low to enter their long positions to then overpower supply and continue the movement. So what do you have? You have a flip that swept liquidity, okay? So now obviously you can draw your flip from the top of the reaction to the bottom of the reaction, which we come back into. Of course, you can refine it to the pivot zone as well. And again, rinse and repeat, right? What do we have? We try and take out the high at that point, right? That would be your range high. Zoom out a little bit, right? You can see the bullish structure forming overall, right? You can see this larger internal structure. We pull back, larger range here, right? So that would have been your low. Okay, so there was always potential, right? Price might have wanted to come down and mitigate something within that wick. But if you actually look, right, that's where liquidity was taken. That's where you had that true kind of last interaction between supply and demand. Then we got the sweep of all of this liquidity here, right? So we're following the money. That was the last big injection of demand. So although price could have come down to the strong low, there's pretty good reason to believe why this might be the next POI where the next swing low is going to form, right? To come to the upside. So we can look for 4-hour continuations within here, right? We can look on the lower time frames and try and get involved. And then we get that next interaction here that sweeps liquidity. So we know there's probably going to be somewhat of a protected low within that range. And then again, what happens? Entices early buyers into the market. They get liquidated. And then we come into that last level there. And then we go. Okay. So, this is somewhat of a sweet POI. Again, it's a little bit far away. It's kind of what I was saying, right? In terms of, so if I draw it on first. To say whether or not, you can classify this particular POI I'm drawing on now as an actual sweep zone, because obviously, I'd like it to be pretty near like that. But yeah, it meets, the general criteria, right? There was liquidity below there. Liquidity was potentially used in line with this demand, right? Using all of that sell side liquidity to enter long positions here to buy against those sellers to then generate that movement there to the upside. And obviously when trading markets are strong, they're not always going to pull all the way back. Do we have any sweep zones in here? Let's have a look. So price comes in, we pull up, right? And then we come down. So we grab the liquidity below that low and that fuels the movement there to the upside. Okay, so hopefully you can sort of see with your eyes now, what we're looking for. Some are obviously a lot more, let's say, significant than others, right? When we have like the big liquidations back here, following the demand chain into the flip, well priced, right? We can start to add in a lot more stuff, but kind of just at this point, like I said, just trying to sort of identify the bare minimum definition of what one is. This one's a bit messy to sort of draw, right? But you do have, that's kind of being the cleaner zone. Price won't always come in and kind of perfectly mitigate that. Sometimes when you get sort of, quote unquote messy price action like this, I will obviously draw it on the nice refined pivot range like that. And I did, it's super nice when price perfectly mitigates that. But sometimes you can kind of read between the lines a little bit and I'd want to cover that wick. Some of you may even potentially want to take the larger range, right? But obviously as price pushes into the zone, then you can refine it a little bit and then look on the lower time frames for your confirmations. And again, another sweep of that low as we came in to that POI, right? Now this movement here fails to break structure on this time frame. So this wouldn't, this here wouldn't be like a valid 4-hour POI, but you can still see the idea of what's happening here, right? It swept that low, demand came into the market and we've come off it, okay? Let's kind of move along a little bit. So, we just keep getting those larger bricks of structure, just following that bullish order flow. Okay, this time we come into, I think this is a flip. So we have this level of demand here. Okay, didn't sweep any liquidity. So this is not what I would call a sweep POI because, let's have a look at it. All right, if you look at the fractal structure, we come up, we pull back, and then all of those candles break the previous candle's high, then we pull back, and then we go. Okay, so if you look at that, it's just an up movement, down movement, up movement, down movement, up movement. So we don't sweep any actual low. Like for there to be a sweep zone, it would have had to sweep that low there, right? It would have had to come down, grab that low and go. So it would have had to sweep this. If that had done that and gone like that, then I would call it a sweep zone. Because for me, or at least at the time of recording, I want to see like an actual, a minimum of like a fractal low that needs to be taken. Now, some people, they will look at like the wicks of the candles and they will say, price came down, grab the liquidity below that low there. And that's for them. Now on a lower time frame, that's probably what would happen, because on a lower time frame, how would that look? It would look like a down movement, an up movement, right? And then price is taking the low. On a lower time frame, you go down to maybe the 15-minute. But on this time frame, think about it the way that we look at fractal structure. What happened? All of those candles broke the previous candle's high, then we pull back, and then we went. So for me, there's no sweep on this time frame. But some people, when they're defining sweep zones, especially with flips as well, they will see that as a valid sweep. Okay, so I'm not saying one is invalid or valid. I'm just saying the way I would recommend you guys do it when you're starting out is the way I'm saying now is you want to see it to be an actual low on this time frame. Okay, so that would be the low that would have to get swept, because in theory that should be more significant, right? Because it's an actual structural low on this time frame. Okay, so I would start with that as your starting point, and as you get more experienced, or you collect more data, but you're then happy to see a sweep zone like that, where you can see that on a lower time frame that would be a sweep. You may want to include that, okay? Because some people do that with their trading. But hopefully I made it clear. I'd recommend you start with the more conservative approach, which is wait for an actual low on this time frame to be swept. That would be sort of my recommendation. Let's speed this up a little bit, because I don't think this needs to be a super long video. But yeah, we'll just do a few more sort of obvious examples, right? Again, we pull back. What do? We mitigate that flip, right? So this is where we had that initial interaction from here. Okay, it's a little bit messy, but there we go. You can see where demand took control from supply, led to the break of structure, and we pull back. What do? We build some nice equal lows, okay? And then you see how it's that aggressive nature that I was talking about. You kind of get that corrective, and then boom, big money is potentially using the sell side liquidity to enter their long positions to then generate the next move to the upside. And that's what I was saying at the start, right? You kind of get these move up, you get this sort of low resistance, right? All of that liquidity building up behind those highs because none of it's been really swept. I mean, there was a bit of a sweep in here. Okay, so that would be, and you can see, right, that POI gets respected because we come down, have a bit of a fractal pullback, grab the liquidity behind that high. So that would have been a potentially good, nice counter trend area to look to get involved on lower time frames, right? Price comes into that 4-hour POI, that swept liquidity, and then we can look for a quick counter trend play down into demand. Okay, but you see behind that, now you've got all of that available liquidity that's been untapped, and that's the liquidity to target. Okay, so typically, like I was trying to say there, is what you get is price will break structure, okay, like that, and then you get kind of usually these corrective moves, which we can trade to the downside, but it leaves that liquidity for us to target, and then price will generally come in, either form equal lows like this, sweep into the previous protected low, and then we get the movement, or like similar thing, corrective move down, and then we'll get like a low that breaks a high. That's the low that then gets swept, and then we go. That's very, very typically what will happen, and then that becomes a much more sort of protected low. Why? Because it signals that big money was involved in there, so they potentially have the intention to try and protect price trading below that low now. Again, what do we have? Price comes in, comes up, grabs liquidity below that low, and then we go. But eventually, we end up sweeping that low, right? More equals, and then we go again, and then we get another break of structure. And then obviously at some point, right, you could be using multi-time frame analysis. We've probably come up into a big daily level, up and towards or sweeping these highs. There's probably like a daily POI up here, right? And we start to shift a bit of structure to the downside, okay? So not getting too much, like I said, into trade ideas. It's more just kind of generally spotting how these sweep zone forms and how those protected swing ranges form right below, as I've kind of gone over. And yeah, we end up actually, you can see, on a bigger scale. We come into this low down here. We build some nice equals, enticing more traders into the market to generate more sell side liquidity below those lows. There we go, trying to draw the poorly drawn dollar sign, sweep that liquidity, and then we go, right, even on scale there. So you've got a nice POI, sweep POI, strong movement there to the upside as all of that sell side liquidity is used, and then almost bring us to where we are. What do we have? See how it just keeps happening now. We come in, we come up, grab the liquidity below that low, then we get a break of structure here, and then this one happens quite quickly. It's probably news or something, but you can see as we break this high here, right? It happens almost in the next, basically straight away in the next candle, but you would have had, right, this breaks the high, so there would be decent liquidity below that low, and price literally comes down, grabs it, not by much, but you literally grabs the liquidity behind that high, and then fuels the next movement to the upside, right? So that was a super quick sweep of that low. After that low had already been swept there. And then we get another mini one here. So price comes down, pulls up, comes down, sweeps the liquidity below that low, another breaker structure to the upside. That then becomes your next sweep POI. Now with those sweep POIs, for like the ones where you get, so price comes in and then you get like a break of a high there, and then you sweep what we call like the strong low, right? That I love POIs that do that. They don't have to. Remember I said with sweep zones, it can just sweep weak structure. So you can also have the example where, let me zoom out a little bit. Okay, let me just go back here. It's easier to show. Here, right? So that's a sweep of a weak low. That's a sweep of a strong low, right? Actually broke structure. So both of those are valid. I just prefer one that sweeps strong structure because arguably more sell side or more liquidity, right, has built below that low to break that high. So in theory, that should be a better zone. So for that low to kind of what I would deem to be somewhat strong, like this low here, right? So we pull in, we come down, we come up, and that just breaks the high. So are we saying this is a strong low that then gets swept? I would prefer it to be one that actually does cause a body closure, okay? But wick break will take it. It's better than not having it. So we get a sweep at that level, come back into the sweep POI, and that would be a level there. And then that pretty much brings us to where we are. I don't know if there's any sort of more clean, obvious examples. But yeah, so hopefully you can kind of get the idea of just what we're looking for. I don't think it's anything too complicated. It's just what we usually do is we just look for those zones as we have been before that lead to a break of structure. You draw it on, you draw the analysis where market structure is it well priced? And then if you just want to ask yourself, is it a sweep zone? Just look left, and did it sweep any available nearby liquidity in the formation of that zone? And it can be another tick in the box as to why this should be an institutional zone and likely will be a protected low. Before we move on, I kind of just want to touch a little bit again, very briefly, on that idea of, how those, protected ranges, those swing ranges are formed with those sweeps of liquidity, and kind of how that, the difference between high resistance and low resistance liquidity. So, just like we're doing on GU and the 4H, but here we're just on the daily on euro dollar, like very often when you get that strong protected low, what does it do? It grabs the liquidity below that low. Just kind of loosely go through this bit. Right, we come here, we kind of form those obvious equals, and then we big grab liquidity, and then we get that strong movement away, okay? I mean, not everything's obviously going to eventually hold, depending on multi-time frame analysis and everything that's going on, but very often you'll see before that next strong sort of move can go, what does it do? It grabs the liquidity below that low. Again, quickly going through some examples here. We get kind of the overall push down, but it grabs liquidity within that leg to then fuel that next movement to the downside. Then we come to the upside, it just sweeps liquidity behind that high by a pip or two. That's one's really, really subtle to see, but I promise you it did just sweep the high there. And then we get the movement to the downside. Again, right, we get the pull back up. Like very often, you're not just going to get like price break a swing low, it comes back up. It's not just generally going to come up with one move and then just come down with one move. Like usually that first pull back up into here, it entices those early sellers into the market, then it grabs liquidity, and then that's usually when you get the movement. And it will usually, just have what we call like low resistance liquidity at the low to target, and then it leaves high resistance, or that high resistance liquidity is taken. So essentially what that means is, you've got just all of that liquidity there sat below those lows. That would be a low resistance low. A high resistance low would be like if the low formed where you got something like this, right? And then it grabbed the liquidity like that. So now if we were, pro trend and we're targeting that low, this one's probably going to be a bit more sticky because there was obviously a bit more, liquidity grabbed in this move. So potentially there was institutional involvement in generating that low. Sometimes when that happens and you get something like that, you can get price come in and it has like a much deeper pullback before we get the real movement. So kind of show you examples like, like here, we get the movement down and then come up, we build all of this liquidity for November and December, grab all of that liquidity, and then we just have all of this low resistance liquidity like this, right? Like trend line liquidity to target. And that's usually why you see that impulsive movement. All of the demand in here is all being absorbed, right? All of these mitigations. Like, so when price comes down, there's just a vacuum in price almost. There's no real demand to absorb price. And then you get that sharp movement to the downside. More examples here. Like I said, right, price doesn't just come back up and just go. Usually you get another movement like that, then it sweeps liquidity, then we come down, pull back into the sweep POI, right, and then we get the impulsive movement there to the downside. Another example here, right, sharp movement down. There's no sweep liquidity down here. We just get that pullback, and then we build some more liquidity, grab the liquidity behind those highs, right, mitigate the decisional flip zone there, right, that flips the demand here, pull back into there, and then we go. Again, get a break, but we don't just like go down. We come up, come down, grab the liquidity behind the high, fuels the next movement to the downside, right? Let's see what else. Like even back here. Okay, this one's a bit more because you do have a bit more of a significant pullback there. So potentially, there's somewhat of liquidity used, a bit more of a protected low came in, and this is where it was tricky because, market's not always going to be super easy to read. Like I remember when back here, I wasn't sure, is that going to be like the true daily break of structure? Are we now shifting bullish and are we going to see this movement? Or, is that just an internal break and this is a larger movement? And that's where you can kind of play both sides of the market, right? Look for the shorts when we come into here, we get the pullback, sweep the liquidity, break of that low. Now you've got to sweep POI to get short. And potentially we can target this low, but then we've also got this potential low here. This is where you can trade both sides of the market. But as we can see, right, we have that impulsive movement down, and then this just doesn't really go anywhere. It's just corrective, building more liquidity, sweep of the high, fails to move, get another sweep of the high, and then that's enough to fuel that movement there to the downside. And then, another example of low, like it just leaving a low resistance low, right? There's no real sweep of liquidity, right? We don't come down, do this, like get a strong sweep and then start pulling back. It's just we come in and then we just come back, right? Build that liquidity, grabs the liquidity, mitigates the previous decisional flip there, and then we get the movement in, right? Corrective movement. So this is a bit more, again, where we could, potentially maybe we're going to get a sweep and go higher. Ends up not being the case. This is a bit more tricky to read, and then we end up shooting to the downside again. And then obviously eventually then we start to shift bullish as the trend comes to its eventual end. These sweeps are a bit more clear on the lower time frame on the 4-hour chart. Not going to dive into all of that now. And then we eventually move to the upside. And like I was saying on GU, right, what do we get? We get a movement in, grabs the liquidity below that low, fuels the next movement there to the upside. Same thing, right? We pull back here, grabs liquidity below that low, fuels the next movement to the upside, okay? So you can start to see how that forms, and it can just sort of help you to understand the flow of the market.